Right now, Bitcoin is sitting precisely at 61,500.
Exactly on the dot.
Yeah, and if you scan the sentiment models in the stack of notes you provided for us today, the loudest internet bears are, well, they're screaming that an apocalyptic crash to 25,000 is imminent.
Oh, totally. They're completely convinced that today's green candle is just a fake out.
Right, a massive trap. But if you look at the live order book data we pulled from your sources, those same bears are unwittingly camping out directly on top of $134 million of explosive market fuel.
It is the ultimate irony of the board tonight. I mean, we have this entire segment of the market obsessing over, historical wave counts and macro prophecies.
Yeah.
And they're completely ignoring the structural vulnerabilities building up in the immediate liquidity pools right under their noses.
Welcome to today's daily trading desk brief. For this deep dive, we are stripping away all that noise. We aren't guessing wave counts, and we certainly aren't trading on vibes.
Definitely not.
Our mission today is to synthesize the data feeds you shared with us. We're reading the live order book and mapping the concrete structural walls of this market.
Right, the actual math.
Exactly. And before we dive into the mechanics of all this, we really need to establish our standard desk disclaimer.
Always important.
Yeah. This is our ground rule for you as you listen. We are reading these levels as exact numbers, observing purely where the capital is resting. We are never telling you to buy or sell.
That distinction is so crucial because our goal here is to map the present reality of the capital allocation, right? Not to predict some guaranteed future.
Right.
Because when you look at where the money is actually staged, it reveals the real pressure points of the market. And those often stand in stark contrast to the popular doom-scrolling theories you see everywhere.
So let's just get straight into the immediate money on the board. Because the real fight happening tonight isn't about some theoretical macro wave.
No, it's about a very physical wall.
Exactly. When I look at the live order book from your data, it tells a story that completely flips this whole bear trap narrative on its head. The structure suggests this trap is actually being set for the shorts.
Yeah, the sheer concentration of capital sitting just above current prices is, it's staggering.
It really is.
When we analyze the immediate liquidity walls, we see this heavily loaded overhead ceiling. Specifically, there is $67 million in short liquidations resting right at 62,100.
And instead of looking at that as just a typical resistance line, we have to look at the actual mechanics of it.
Right.
If price pushes into 62,100, we aren't talking about organic buyers deciding to step in because they like the project. We are talking about automated margin calls.
Force buying.
Yeah. That 67 million acts as an avalanche breaking the surface tension of the market.
The structural mechanics of force buying are brutal. When those automated margin calls trigger, the exchanges just buy back the asset at market price indiscriminately.
And just execute.
Exactly. It creates a violent, involuntary bid. But the thing is, the 67 million at 62,100 is just the surface tension. The real danger for the shorts lies just above that.
Right, at 62,700.
Yeah, at 62,700, there is a significantly denser pool resting. We are looking at $134 million in short fuel.
Wow. So the avalanche at 62,100 essentially sweeps away the support pillars for that massive shelf at 62,700.
Yes.
If price hits that lower trigger, the sheer momentum of the automated buying pulls us directly into the heavier pool, creating a massive structural squeeze.
A total chain reaction.
But for any of that upside mechanics to actually play out, the floor beneath us has to bear the weight. Yeah. And I'm looking at the downside data here, and there is a very precarious structure keeping this all propped up.
Precarious is absolutely the right word for it. Underneath current prices, there is a $155 million pool of long liquidations resting precisely at 60,300.
Okay.
We view this as a trapdoor. It's basically the inverse of the overhead ceiling we just talked about.
Right. So if we go down.
Yeah. If the market bleeds down to 60,300, that trapdoor swings open. And $155 million of forced selling hits the bid all at once.
Which would instantly pour gasoline on any downward momentum.
Exactly.
And this is where the bear's positioning becomes kind of mathematically absurd. You have the loudest voices calling this current bounce a trap for buyers.
Right.
But their own invalidation trigger, the exact price level that definitively proves their crash theory wrong, is sitting directly on top of that $134 million squeeze fuel.
It's wild.
To defend their thesis, they essentially have to set up camp on top of a live fault line.
It is a massive structural vulnerability for anyone heavily short right here. And to complicate their thesis even further, we have to look at how different technical lenses are converging on that downside floor.
Okay, what do you mean?
Well, on the desk chart you provided, there is a sharply ascending trend line that buyers have aggressively defended over the last few sessions.
Yeah, I see that.
That ascending slope terminates directly on top of the 60,300 liquidity pool.
Oh, wow. So you have dynamic price action, the trend line and static order book data, the liquidity pool, creating the exact same line of defense.
Yes.
The physical floor and the psychological floor are one and the same. It creates a very binary reality, doesn't it? Hold 60,300, and the structural advantage remains with the buyers.
But if that 60,300 trapdoor gives way, the mechanics reverse violently. The question then becomes, where does the market find its next stable footing?
Right. Looking at the data stack, if we lose that 60,300 floor, I see an immediate vacuum down to the 54,000 to 55,000 zone.
Yeah, that is the primary downside magnet. Mathematically, 54,600 is where the 300-week moving average currently sits.
Okay.
And that moving average perfectly aligns with a historical support shelf that cascades down toward the 49,000 level. So mechanically speaking, if the $155 million trapdoor opens, the 54,000 zone is where the initial momentum naturally exhausts itself.
And here is where we have to firmly separate the observable data from it is a mechanical reality of the order book. But the extreme bearish models you included in this deep dive stack aren't stopping at 54,000.
No, not even close.
They are modeling absolute systemic devastation. I want to map out these deeper targets, but we need to be crystal clear for you listening that these numbers belong to the independent models circulating the market, not the immediate desk data.
That's a vital distinction. We analyze the models, but we don't adopt them as gospel.
Right.
According to their roadmap, 54,000 is 37,000. 37,000. That's rough.
Yeah, which represents a 70% drawdown from the highs.
A 70% drawdown implies a massive capitulation event across the entire asset class.
It does.
But they take it even further down, right, to 25,000.
Yes. The 25,000 target is anchored to a major technical Fibonacci level. It's the 78.6% retracement, which technically sits around 24,000.
Okay.
It constitutes an 80% total drop. But the most extreme call in their playbook targets the 12,000 to 13,000 range.
Wait, 12,000?
Yeah.
That represents a catastrophic 90% decline. I have to ask about the underlying logic of a 90% wipeout to 12,000. Are they purely doom scrolling, or is there an actual mathematical foundation for modeling a drop that severe in the current market structure?
Their foundation relies entirely on historical symmetry.
Okay.
The core argument assumes that because previous Bitcoin bear markets, specifically looking at the 2014 and 2018 cycles, experienced 80 to 90% drawdowns, the cycle is bound by the exact same physics.
Ah, I see.
Yeah, they are operating on the premise that Bitcoin's market structure hasn't matured at all. They assume $1 of sell pressure today will have the exact same percentage impact on the order book as it did 8 years ago.
Which completely ignores the introduction of institutional spot products.
Completely ignores it, yes.
And they are anchoring this entire historical symmetry argument to a very specific macroeconomic catalyst, right? It's not just a vacuum of buyers in the crypto space.
Yeah.
Their models require a massive exogenous shock from the traditional equity markets. The macro frame is the linchpin of their entire 12,000 thesis. The models assume that the S&P 500 and the NASDAQ have already put in their cycle tops back in early June.
Okay.
Their fundamental theory is cross-asset contagion. So if traditional equities suffer a violent contraction, institutional capital will just indiscriminately liquidate their Bitcoin positions to cover margin calls in the equity markets.
Makes sense on paper.
Yeah. Specifically, their timeline relies on a 20% drop in traditional stocks.
Well, I see the logic in cross-asset contagion, but I really have to challenge the certainty of this 20% equity drop triggering their specific timeline. They are pegging this 20% drop as the exact pain threshold that forces the Federal Reserve to completely reverse policy ahead of the November midterms.
Exactly. They are modeling a scenario where a 20% contraction creates enough political and systemic panic that the Fed is forced into a late pivot.
Our rescue operation.
Yeah, shifting from restrictive rates to aggressive cutting. Not because inflation is conquered, mind you, but as an emergency rescue operation. And in their timeline, that panicked pivot designates the fourth quarter as the absolute bottom of the cycle.
Right.
They also point to the fact that Bitcoin recently lost its 200-week moving average as technical confirmation that this macro weakness is already bleeding into the crypto charts.
The problem with treating this Q4 pivot as an inevitable reality is that it requires a mountain of ifs to perfectly align.
So many ifs.
The macro pivot is a weather forecast built on assumptions. If the S&P drops exactly 20%, if the Fed decides equity drawdowns matter more than sticky inflation data, if the midterms force their hand.
Right.
Contrast that with the liquidity walls we just discussed, the $60,300 trapdoor and the $134 million squeeze fuel. That is the actual rain hitting the windshield right now.
It's the difference between trading a theoretical calendar and trading the observable capital. We know from the Fed's recent June projections that the committee's dot plot still leans heavily toward prolonged restriction. So banking an entire portfolio strategy on a sudden Q4 rescue operation requires you to basically ignore the Fed's own stated timeline.
Which brings us right back to the reality of the board tonight. Let's pivot this macro fear into the rotation scanner you provided.
Okay, let's look at it.
If capital is actually terrified of a cross-asset contagion event dragging Bitcoin to 54,000, we should see that terror reflected in the broader market breadth. Looking at the scanner, what is the capital flow telling us about the market's true conviction?
The scanner reveals a really fascinating psychological landscape. Across the 127 tradable pairs we monitor, we are looking at $15.3 billion in aggregate open interest.
That is a massive amount of capital actively deployed.
It is, but the distribution of that capital is incredibly lopsided.
Let's look at the sheer scale of that imbalance. Out of the names we track, 114 are showing weakness against Bitcoin, while only 67 are showing any relative strength. That tells me money hasn't really left the ecosystem. It's just paralyzed or repositioning very defensively.
It is a textbook flight to relative safety. Capital isn't spreading outward to seek alpha in the altcoin's liquidity.
Right.
We're watching Bitcoin dominance rise while the rest of the board bleeds. And historically, this specific market behavior, where Bitcoin absorbs capital while higher risk assets get crushed, is a mechanical signature of a late-stage flush. Not the first rotation of a multi-year bear market. Ironically, this defensive posturing favors Bitcoin's structural resilience in the near term.
It's a risk-off tell, but specifically a flight to the lowest beta asset in the space.
Exactly.
So the vast majority of the board is weak. But let's analyze the few names that are actually flashing green on the scanner today. Does this strength represent genuine institutional conviction, or are we looking at structural anomalies?
You really have to look under the hood of the price action here. The strongest relative performer on the scanner tonight is Lab. It's sitting on a nearly 29% relative gain against Bitcoin.
Wow, 29%.
Yeah. But however, the internal data flags Ella as having heavily crowded shorts.
So Lab's upward momentum isn't organic buying, it's structural snapping.
Right.
Traders piled in to short the asset, the funding rates went deeply negative, and now they're being violently forced to buy back their positions. It's a coiled spring unwinding, not a fundamental vote of confidence in the project.
Precisely. It is entirely a mechanics-driven move. Then you look at an asset like HYPE.
Let's see.
HYPE currently holds $341 million in open interest, but it's churning on $700 million of volume.
That is just pure casino leverage.
It really is.
When volume outpaces open interest by that magnitude, it means traders are frantically opening and closing highly leveraged positions intraday. It's moving incredibly fast, but leverage of that density cuts violently in both directions. There's no stable foundation there.
It's just noise. But amidst all the squeezes and the casino volume, the scanner does highlight one instance of genuine structural strength.
Oh, yeah. Which one?
Beat. The internal metrics for Beat explicitly show longs building underneath the price appreciation.
Okay, that's different.
Yeah. This indicates real capital stepping in. They are accumulating spot or establishing unleveraged long positions to actively support the move, rather than just riding the coattails of forced liquidations.
Okay, so Beat shows genuine accumulation, but I really want to talk about the trap side of the scanner, because this is where market mechanics punish undisciplined capital.
Yes, let's get into it.
I'm looking at high beta names like PMP and Grass. These are assets that essentially exist to multiply Bitcoin's volatility by 3 or 4 times. They're up 10 to 17% today. To an untrained eye, that looks like a massive breakout.
It looks incredibly enticing, right? And it is exactly the kind of setup that destroys capital. Traders see a wall of green on those high beta names and assume the broader market is entering a massive bull run. What they fail to realize is the underlying dependency. Those moves in PMP and GRAS are nothing more than highly leveraged bets that Bitcoin's 60,300 trapdoor is going to hold.
They are just derivatives of Bitcoin's floor. If Bitcoin simply coughs and loses that 60,300 level, those high beta tokens catch the plague.
The mechanics are brutal. The absolute second Bitcoin 60,300 trapdoor opens, the liquidity in those high beta names just vanishes.
Gone.
They will be the first assets to flush, and they will flush the hardest because their entirely leveraged foundation will instantly collapse. Anyone buying them today is implicitly betting their entire position on the integrity of Bitcoin's immediate order book.
This synthesizes our entire analysis perfectly. Whether we are looking at the 12,000 macro models, the altcoin rotation, or the immediate leverage, the entire market's fate is currently tethered to a handful of concrete levels. And like we said, the desk doesn't pick sides based on sentiment. We let the structure dictate the narrative. So let's map out the definitive triggers for you. Based on everything in this data stack, what is the exact mechanical sequence for the bull path?
Okay, so the bull path requires a structural climb, step by step.
Step 1.
First, price must reclaim 62,100. That action breaks the surface tension and forces the initial $67 million short pool to cover.
Right.
The resulting momentum must then carry the price into the 62,700 zone to ignite the heavier $134 million liquidation pool.
That's the squeeze sequence. And if that chain reaction plays out, what is the ultimate level that invalidates the macro bear models?
Well, if they ignite that squeeze, the final structural hurdle is reclaiming the 200 period moving average, which currently sits up near the 75,000 level.
Okay, 75,000.
If buyers can force the price up to 75,000 and establish it as support, it completely dismantles the bearish thesis. They would have conquered the exact historical resistance the models claim is impenetrable.
So the bulls have a clear 4-step staircase, right? Trigger the first pool at 62,100, ignite the main fuel at 62,700, ride the momentum, and conquer 75,000.
Exactly.
Conversely, map out the bear path for us.
The bear path isn't a staircase. It's a single trapdoor. Everything hinges on 60,300.
The $155 million question.
Yes. If the market bleeds down, loses that 60,300 floor, and fails to immediately reclaim it, the narrative completely flips. The $155 million in long liquidations flush into the market.
Ouch.
That supply shock immediately targets the 54,000 to 55,000 vacuum. And if that 300-week moving average at 54,600 fails to hold, the floor is basically handed over to the macro models aiming for 37,000 and beyond.
It really strips away all the noise, doesn't it? You have a 4-step squeeze to validate the bulls versus one single structural failure to unleash the bears.
That is the immense value of mapping the concrete walls.
Yeah.
We don't have to debate whether the Federal Reserve will panic in Q4. We don't have to guess if a 20% equity drop is imminent.
Right.
We just have to watch how capital behaves around 60,300 and 62,100.
As we wrap up this deep dive into your sources, keep that ultimate near-term fork at the forefront of your strategy. On the downside, you are staring at the 60,300 trapdoor. On the upside, the 62,700 squeeze.
Everything happening between those lines is just market noise attempting to distract you.
And please remember our desk disclaimer. Nothing we have discussed today constitutes financial advice. We have mapped the exact concrete levels based on the live order book data you provided, but how you navigate those walls and manage your own risk is entirely up to you.
The data provides the topography, but you are the one flying the plane. Knowing where the mountains are is really only half the battle. Executing the flight path requires discipline.
Perfectly said. But before we sign off, I want to leave you with a final, provocative thought to explore on your own, building on the models you shared.
Oh, this is a good one.
Yeah. Those deep bear models relying on 12,000 are entirely anchored to the sacred 4-year cycle clock. They believe historical timing dictates a catastrophic bottom in Q4. But consider this mechanical scenario. What if the market holds this 60,300 trapdoor, violently squeezes the shorts through 62,700, and fully reclaims the 200-period moving average at 75,000 before Q4 even begins? Does the introduction of institutional spot capital mean that the sacred 4-year historical clock is fundamentally broken for this cycle?
It is a massive structural question. If the immediate liquidity walls dictate a reality that completely front-runs the historical calendar, well, an entire industry of forecasters will have to throw out their models and start from scratch.
Which brings us right back to our original premise. Are you going to trust a 5-day weather forecast built on old cycle data? Or are you going to trust the concrete wall sitting right in your front yard?
I know which one I'm watching.
We want to know what you want us to pull from your notes for the next deep dive. Do you want us to unpack the full mechanical map of that upside squeeze towards 75,000? Or do you want a deeper forensic breakdown of the downside sequence if that 60,300 trapdoor gives way?
Let us know.
Until then, keep your eyes on the walls.